My dear brothers and sisters, we congratulate you on your devotion to aliveness in the food you eat, but we urge you to stand up for aliveness in the world out there. It's what we've got to do in these times. With that in mind, we're going to ask, what is it that cryptocurrencies have come to teach? And in order to understand, we've got to go back to the 17th century, to a phenomenon called the Dutch Tulip bubble. It's one of the earliest examples of an asset bubble. Dutch speculators caught a pandemic of irrational exuberance, something new to Europe. People bought and sold bulbs, pushing up prices. People rushed to the market after hearing about all the money being made. Over the course of a few years, the price of tulips increased 200 times. At the peak of the bubble, a single bulb would sell for 10 times what a worker would earn in an entire year. Imagine that. Then, in just 1 month, the bubble burst and the price of tulips dropped to nearly nothing. Tulip Mania was one of the first recorded speculative bubbles. We are now caught up in cryptomania. FTX, a company based in the Bahamas, was paying a yield on cryptocurrency. But crypto, a form of money in and of itself, does not generate a yield. It is the fakest of fake money, just ones and zeros in a computer. It is worthless. FTX managed to lose some $2 billion in a day. Imagine that. One would think that the hedge fund managers that invested in the company using other people's money would do a bit of due diligence. But then they were drunk on cheap money. Tulip Mania once again. Let's take another example. During the 1920s, the stock market underwent rapid expansion, reaching a peak in August 1929, amidst wild speculation. There were signs. Production was declining, unemployment was rising, stocks were valued greatly in excess of their real value. Among other causes of the eventual collapse were low wages, the proliferation of debt, a struggling agricultural sector, and an excess of bank loans that could not be liquidated. Stock prices began to decline in September, and in early October, the fall began. Panic set in. On October 24th, Black Thursday, a record 12 million shares were traded. On Monday, the storm broke anew, and the market went into free fall. Black Monday was followed by Black Tuesday, in which stock market prices collapsed completely. 16 million shares were traded in a day. Billions were lost, wiping out thousands of investors. Stock tickers ran hours behind because the machinery could not handle the tremendous volume of trading. Sounds like Tulip Mania once again. But that's not all. Prices continued to drop, and the country slumped into the Great Depression. By 1932, stocks were worth only 20% of their value in 1929. Now, the stock market crash was not the sole cause of the Great Depression, but it did act to accelerate a global economic collapse. By 1933, nearly half of America's banks had failed. Unemployment was approaching 15 million people. Imagine, 30% of the workforce was unemployed. Then there was the dot-com bubble. The arrival of new internet companies to the stock market led to excessive speculation. This is in the late 1990s. Many new firms were able to win huge valuations, even though they generated very little or no profit whatsoever. There was a mania for technology stocks, and it had all the ingredients. Everything was set for a roller coaster ride from boom to bust. Glamorous sounding products that investors knew very little about, greed, and an economy firing on all cylinders. Selling at the top of the market in early in the year 2000 triggered panic. Suddenly, the sources of funding for flashy companies that never made a penny dried up, and this was followed by the inevitable market crash. Sounds like the tulip bubble once again. Then there was the subprime mortgage crisis, 2008 and 9. Banks irresponsibly led to U.S. households who couldn't afford the mortgages they were being sold. The banks made massive returns by packaging the loans into bonds and then selling them. When the number of households falling into arrears on their mortgages began to rise, investors began to wake up. This triggered the collapse of the banking system in 2008. The U.S. government responded by using taxpayer dollars to finance multi-trillion-dollar bailouts for the biggest Wall Street banks. Tulip Mania once again. To be sure, the 1929 crash, the dot-com bubble, and the 2008 crisis were manifestations of profound structural weakness. But the froth at the top was the tulip mania, delirium. But that's not all. After the collapse in 2008, the Federal Reserve and other major central banks embarked upon ultra-low interest loans and pumped trillions of dollars into the financial system. They called it quantitative easing. Ultra low interest rates led to bubbles, but of course, starting in early 2009, the stock market tripled in value. Thus, cryptomania, which we're currently experiencing, is part of a much larger bubble. Cryptomania was created by the central bank by resorting to the printing press to make the financial markets flush with cash. And things have reached the state where total private and public sector debt as a share of gross domestic product is 420%. Total debt, private and government, is 420% of gross domestic product. When and how this bubble pops is difficult to predict, but one thing is clear: when it does, it will take a substantial chunk of the real economy with it. There may very well be a worldwide financial meltdown, bringing with it massive unemployment. The layoffs have already begun. Yet at the same time, prices keep going up. That's the prospect for 2023. Inflation and depression. May I close on a happier note by saying this is the time to plant a tree. May I suggest that you plant an heirloom and historic fruit tree by way of saying that come what may, we will pull through. I thank you for the opportunity to share. Your comments and suggestions are most welcome. Let us go forward.